Hi traders, welcome to our video series today on the 7 steps to achieve consistent trading performance. Today we are on part 6 out of the 7-part video series, and in part 6 we're going to be looking at step number 6, defining your strategy CO. What is this all about? We're going to be covering this and more in this trading video. Hi traders, thank you for joining the Master the Markets team in our video series today and supporting us in our mission to spread the truth of trading and help you achieve consistent performance. It is Tune Upon here, founder of Master the Markets Elite Trades Conference and the Traders Open Day. So here we are, traders, on step number 6. Define your strategy CO. So what is the CO all about? Now, the CO is basically the first part of the CO is the C, which is what we call the concept of the strategy. Now, traders, the issue is most people are always running after strategies. And the sad thing is, not many people out there really teaching about strategy construction. Now, before you even construct your strategy and look at your rule parameters, one of the most important thing that you should be looking at is what is your strategy concept all about. Now, why is that important? You see, think about it. If you are looking to build, let's say, a car or something like that, now, based on the audience, the target audience that you're going to sell that car for, is how you should be then choosing the tools to construct that car. Is it not, traders? So, if, for example, if I were to just use on the charts and draw on it, so for example, if you're looking to design and build a car, let's say for an audience that are sports raving fans, okay? Right now, and you found out that in the place that you want to sell this car, 80% of the population are sports raving fans, all right? So what do you then do? Once you got that kind of objective and the concept, it's got to be a fast car and all that, then the tools that you choose for the car will be in according to that concept, is it not, traders? So you see, for example, the engine that you choose will have to be a turbo engine, much more faster than rather than choosing for a family car, right? Engine, and then also you will just choose 2 doors instead of 4 doors as well, right? The gearbox will be it's got to be fast, to accelerate as well. You see, a lot of these things, once you have defined the concept of what you're building the car for, the tools that you choose will start to change as well. So
If you're enjoying this video, go ahead and smash that like icon. If you haven't joined our channel yet, click on the subscribe button and hit the bell icon so that you get notifications immediately when we post up quality content like this, and especially to get our live trading updates sent directly to your phone.
going back to here, if you take a look, right, in terms of our concept, what are the few different types of concepts that we can use for strategies? Okay, so let me give you some example. So one is, in terms of a concept, it's always got to be based on a recurring principle. Now, this is very important, traders. A recurring principle that keeps recurring in the market again and again and again, right? Now, why is that important? Because the recurring principle is what gives you the confidence in continuing to carry on to capture that principle in the market that keeps repeating itself. Okay, so even when you take losses or profits, it will keep you giving that motivation to capture that, because it will keep recurring. And therefore, the only thing that you really need to keep focusing on and improving is your skills to capture that recurring principle that keeps recurring in the market. Now, that also recurring principle also defines the edge of your strategy, why that strategy will continue to work. It's a part of the puzzle. Okay, right. So what are some examples, right? Some of you are asking, what are those examples, Tiru, so that I can get an idea of what you're really talking about. Let's take a look. Some examples. One is that a recurring principle that keeps occurring in the market is based on the fact that price never moves in a straight line. If price never moves in a straight line, it will move in cycles, right, traders? And if it moves in cycles, it will create turning points in the market. So you see, a turning point principle is something that is recurring. Now, if I go on to the charts over here, in terms of even looking at this in real time, let's say across different instruments, you can see that at the moment, you see on cable on the daily time frame, right? So this is a bottom that has been confirmed according to our quantification over here. And at this moment, as you see this retracement, all you can ask yourself is that going to become a turning point of a top? And do I want to continue to take that trade in that direction of a top to bottom move? You see, for example, if I take a look at gold as well, I mean, it's the same things keep recurring, is it not, traders? You see, the market never moves in a straight line. That's what you're getting over here as well, is it not? So if you take a look, the market doesn't keep going straight and straight and straight. You see, look, it starts to turn up and down, starts to chop, but still is making it tops and bottoms according to our quantification. Okay, you can see there's a bit of consolidation which is broken out. Now is carrying on its top to bottom move, made a bottom here. That's my point. Turning points keep recurring. Now, even if you pull out one last instrument to just give you the idea, the concept is that if you want to build a strategy based on the concept of capturing turning points, you can see that it keeps recurring, is it not? It just doesn't keep going straight all the way, does it? It keeps doing its turning points in between. So I guess you get the idea, right? Of a recurring principle that keeps occurring again and again. What's another recurring principle? For example, another one that keeps occurring again and again is bar ranges. Let me pull up another chart over here for you as well. We go through S&P, you see I was doing this over the coaching session as well with other clients as well. You can understand and appreciate traders that if you look, something that keeps recurring that you can use in intraday strategies is, you see, look at this traders, yeah? Every day, if you look between the high and the low, whether you're looking at old Chelsea bar or you're looking at candlesticks, there is a distance formed between the high and the low of the bar. Is it not every single day? Look, right? And that is what we technically call the range, isn't it? So that's another thing that keeps recurring. And if you were to average that range out, that's how we get the average true range that happens per day. For example, over here on the S&P, if I look from yesterday onwards, you can see on the ATR over here. Let me just put that over here. So over here, you can see the ATR over here is telling me that it's about 90 or 91 or whatsoever, isn't it? Yeah, and on other things, so on and so forth. We can see on gold over here is 23.71 and so on. So forth. That is showing us the different points over here on the S&P. You can find that as well, right? It's about 42 as of yesterday. So you see, that's something that keeps recurring again and again, the range, okay? And then using that range on an intraday strategy, you can use that concept of range and build range concept based strategies. Okay, that's what you can do as well. Okay, a range keeps occurring every day, and it's a recurring principle. Now, another thing that you can also look at, one more thing I do want to tell you guys as well. You see, in a vertical bar chart, right, traders, you see how this principle is quite powerful. In a vertical bar chart, most traders are all looking at vertical bar charts, right? The only way a price can move up is by making the distance between the high and the low, is it not? So the range must form. Now, if that instrument you're trading, it's very less volatile and very illiquid, what will happen if there's no distance between the high and the low? If there's no range formed? What do you think will happen if there's no range formed at all? Yes, some of you are getting it. If there's no range at all being formed, what you will get, traders, is that a flat line, isn't it? Right? Like an ECG straight flat line, which is like a dead man, right? So of course, and you don't want to be trading those kind of instruments, right? You want volatility and in your favor so that you can make it into a net profitable strategy based on your strategy construction rules. So in this type of principle that the bar ranges will form, it makes sense, isn't it? It's got to keep recurring. If it's a liquid instrument, there will be activity between the buyers and sellers, which will create a distance between the high and the low, which you can start to trade within the intraday time frames. Now, the last thing is another principle that you can take a look at is stops and continuation. This keeps occurring, is it not, traders? That in the market, you get some retracements, right? When in, let's say, for in this top to bottom move, it starts to retrace a little bit, stops people out here, and then continues, right? Stops and continuation. Based on this concept, you can also make strategies. Over here's another understanding here, right? So the bottom to top move, then you can see that the market goes down and then stops people out and then continues, right? Stops and continuation. Okay, that's another principle. Now, how do you write all this into your crib sheet or into your strategy rules or your strategy plan, whatever you may call it? I'll just show you some examples over here. So you see concept of strategy, right? There's move left after a swing low or high is confirmed. Usually there is, right? Or the range concept, which I talked about just now, or a turning points concept. The turning points concept, if you want to get a bit more specific, you can say that a bottom on a lower time frame eventually becomes a higher time frame bottom. Okay, because think about it, traders, once you've quantified what your tops and bottoms is, which I've gone through in the previous sessions in actually the 7 steps to achieve consistent performance. Now actually, let me show you that very quickly. Under our profile here, if you take a look under Master the Markets 2010, where you can start to follow us over here, if you go under streams, you can start to see all the different parts of the 7 steps what we are covering over here. Okay, so you can definitely take a look at that.
For those of you who are unsure of any of the terminology or the concepts in this video, watch our free Trader Starter Pack 5-day video course as shown in Empire Cinema. It is educational, entertaining, and covers basics and advanced content with cross-transferable principles for trading and investments. It pertains to both beginners and intermediate traders, all dedicated towards helping you achieve consistent performance. Go ahead and register for it on the link below.
Now going back into the um, the charts, all I'm saying over here is that the bottom, as I mentioned, the concept is that a bottom on the daily, right? The bottom on the daily was once. Let me just draw that blue line here, the low here on the gold, let's say 1931. The bottom on the daily was once basically a 4 hour bottom. Was it not, traders? So you see over here, the 4 hour bottom, it was once a 4 hour bottom, which held on to become finally the daily bottom. Or you can also say that it was once a 1 hour bottom. Basically, it's a ripple effect, is it not, traders? Yeah, the ripple effect where it was once, you see, that 1 hour bottom which held and never went below that blue line to finally become that daily bottom, which then signifies over here as a dot over here, isn't it, according to our quantification. Yeah, so that's the whole concept of capturing a turning point strategy. That's how you can build strategies based on turning points concepts. Okay, and finally then you can look to exit on confirmation or 80% OE. Now that actually swiftly brings me to the second part of the strategy construction. Before you even start to construct your strategy, what is the O stands for? So we got the C, which is concept. The O actually stands for, now before I carry on, just a side point, traderstarterpack.com is where our 5-day 5-part video series is, which is one part is released over one day. I highly recommend you guys to watch it. It's over 12 years of collated research that we have built this video series together. So definitely watch that. This kind of principles will be covered there as well, and things that you never heard anywhere before, because it's all institutional quant based. Now, going on to the the O part of it, I mean, this one I've already told you about, right? So the turning point concept, to enter the turning point cycle. I'll swiftly carry on to the O. What does the O stand for? The O actually stands for the objective, traders. The objective. What is the objective of your strategy? What do you want to capture? Let's say, for example, in a swing move, right? In a swing move, how much of that move do you want to capture? What is the objective of your strategy? What is the objective? How much move does it want to capture? So over here, if you can see that, as I said, what's the objective of your strategy? You can say to capture how much of the move. Usually, as swing traders, do you know how much you really want to capture? Ideally, you're looking to capture actually 70% of the move before it turns and becomes a top. Okay, that's what you want to be looking at. That's an objective of a strategy. So let me show you some examples of objectives. Let's say let's move left after a swing low or high is confirmed. So for example, one objective that you can look at is basically to capture the 50% open equity distance, right? To capture the 50% open equity distance, as you can see over here. To capture the 50% open equity distance on a high probability swings that will get there. So for example, we don't need to be trading. I show you an example over here. We don't need to be trading all the swing moves, isn't it? All of them, not all of this we don't need to trade. All the dots we don't need to trade of all the swings. We choose and select those dots which we believe is going to be a good runner to get to my distance that 50% of the runners will get to. Okay, what we call 50% open equity distance, which I can find from my open equity table over here. Okay, because we have quantified the bottoms and tops. Okay, and once I've got that objective, I can exit my trade. Okay, I don't care how much it moves after that. For example, the 50% move on currencies, usually after my point of entry, which is usually on the dot over here, is usually about 100 pips. Okay, and I can find that from, which is already done in this move. I can find that all from this table. Let me just expand that a bit. When I go on to here and I use the OE numbers, and then let's say I just do 25 and 25 over here, spanning over 15, 20 years, and I press greater than or equal to, and it will start to populate the numbers for me. And there you go, I got my 50% number, which is about 125. Once I hit that number, I can get out. To improve my probability, I select those dots. I don't need to trade every one of them. Okay, traders, so you see now, let me just see over here. So I've gone through the objective of the strategy. So far, what have we done? We've gone through two important things for strategy construction. Even before you start to build a strategy or start to build your call or start to choose and mix and match the tools, you need to first define the concept of your strategy and then finally the objective of your strategy. The concept is based on recurring principles, and the objective of your strategy can be based on statistical probabilities, which we are helping you formulate from the methodology of open equity. After you have quantified your bottoms and tops, which we have done, which gives you a solid framework to work from and build sustainable, scalable, reproducible strategies. Okay, traders, I guess that's pretty much that from me on this video on part 6 out of 7 on the 7 steps to achieve consistent trading performance. Just a quick reminder, traderstarterpack.com, you can find most of these principles being spoken over there in our 5-day video course. Okay, right, I guess that's pretty much that. Quickly just do a quick check, see if any questions over here. Not really much. Is there any questions? I can see some people saying hi and all that. But if there are no other questions, even if you have questions even after the stream as well, we'll be happy to answer it. Or you can also message us as well on our profile. Now, let me see if I can bring up my our profile once again. That would be under Master the Markets 2010, where you can start to follow us, and whenever we put live streams or ideas where we're taking live trading positions, you can then get that first hand All right, traders, I'll bring this to a wrap. And if you've got any questions, of course, feel free to email us, okay, at clientservice@masterthemarkets.net. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.
If you want to get notified every time we put a video up, especially on our live trading update videos, hit the subscribe button and turn on the bell notifications icon. This will get the YouTube algos to kick in and for you to join us in our mission to spread the truth of trading further, so that traders like you can benefit from our videos to trade like a master, achieve consistent performance, and change lives.